Trump made clear what he thought. And I think we're going to see a lot of legislative moves that will legitimize crypto in the eyes of people who are just going to stay away from it until we had our regulatory act together. I think this is going to be a golden moment for equities. I think it's going to be better than the 80s and 90s.
Cathie Wood begins by highlighting Bitcoin's outperformance compared to other cryptocurrencies, especially as the U.S. heads toward the 2024 elections. Wood emphasizes how crypto has become a bipartisan issue, particularly among younger voters, as both parties increasingly recognize the potential of digital assets. She points out that former President Donald Trump has clarified his supportive stance on crypto, which could lead to increased regulatory attention aimed at legitimizing digital assets. Wood notes the shift happening within the SEC. While SEC Chairman Gary Gensler has had a cautious stance on crypto, Wood believes he may lose influence, giving way to a more crypto-friendly approach.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
Bitcoin has been outperforming most of the longer tail assets within crypto. As we were moving towards the election, it was becoming so clear that crypto is a bipartisan issue, especially young people. And so both parties were catering to it, but I think that Trump made clear what he thought. And I think we're going to see a lot of legislative moves that will legitimize crypto in the eyes of people who are just going to stay away from it until we had our regulatory act together. So from a regulatory point of view, I think Gary Gensler will be out of business. And we know from the research team at the SEC and others that there was much more support for crypto inside the SEC. Certainly Bitcoin, but crypto a little bit more broadly, just more of an open mind, I would say, than many people appreciate. So, and then on the legislative side with Senator Lummis and Senator Gillibrand, I think we're going to see legislation that is going to be very crypto friendly, because the U.S. wants to lead in these three revolutions: the money revolution, which is primarily Bitcoin, global rules-based monetary system, the DeFi, the financial services revolution, DeFi, decentralized finance, or I'm hearing it called the Finternet. I learned that from an Indian person in India. They're calling it the Finternet, which, think about it, that actually rings true. This is, the layer of the internet that no one built in, the developers did not build in, because we didn't know about financial services and commerce in the early 80s being a thing online. It just didn't occur to anyone. And then the third revolution is Web3, or, the digital property rights revolution. And that's going to be huge. And so I think this administration is going to be very friendly. After all, Trump loves the idea, and Melania as well, of these crypto assets, or Web3 assets with his face on them. And so I think it's going to be fun. I think, the U.S. really spawned the internet revolution, and I think we'll carry on now. President Trump says he wants interest rates down, and I think he's thinking especially about mortgages, because housing affordability has just crashed in this cycle. if we're right and the economy starts growing at an accelerated rate, which is what the long bond yield, if you look at the breakdown between inflation and real yields in the long bond, you can use tips to do that. More of the move recently has come from real rates. Some has come from inflation. Now, one of the mistakes I think people make is something called the Phillips curve. They assume that when employment is strong or the unemployment rate goes down, that inflation goes up. And if you look at the 80s and 90s, and I think we're going into that kind of environment again, you'll see that as real growth accelerated, inflation came down. Why? Productivity. You get good unit growth, you get the productivity coming down. Now, the reason people don't think we'll see a repeat of the 80s and 90s is we started at a 15% inflation back then. And here we're at 2.5% inflation, roughly, depending on the measure. And they're saying, well, what does that mean? Productivity and inflation coming down. I think some pricing's going to actually go negative because technology is inherently deflationary, but this is good deflation. Your consumer electronics product prices come down over time, or they increase the quality. So I think we're going to see a lot more of that. And I think that's going to be one of the biggest surprises. Much lower than expected inflation, interest rates as a result lower than expected, even in a rapid growth environment. And I can just sum it up by saying this. We have lived in roughly a 5% nominal GDP environment, say 2% real and 3% inflation. Can you imagine, if we're right, an economy where maybe we're growing 4% real and inflation is 1%? It's still the same nominal, but we think that could happen. And part of that could happen because because technology's permeating every sector, blurring the lines between and among sectors, this deflationary influence. AI training costs dropping 75% a year. AI inference costs dropping 85-90% per year. That's going to permeate every sector. So I think this is going to be a golden moment for equities. I think it's going to be better than the 80s and 90s. Many people are calling, innovation-based strategies a new asset class. And I find that so unbelievable because we're talking about the equity market and it is not a new asset class. But I think that the surprise here is going to be that these smaller companies are now going to be given some running room. And this is the broadening of the market. And I think we're going to see, incredible creativity, entrepreneurial spirit, animal spirits coming back. And those stocks have been neglected. Really, they've been neglected if you look at our strategies for certainly the last 4 years. In total, of course, we've seen light at the end of the tunnel from our AI and next generation internet strategies. But the earliest stage, the multi-omics, genomic revolution strategies have been quite disadvantaged, and I think they have a lot of catching up to do.
Wood believes that a similar situation could unfold if the U.S. successfully embraces new technologies, especially AI. As AI boosts productivity, it could lead to higher growth with lower inflation, benefiting the dollar and bolstering the U.S. economy. She argues that lifting regulatory constraints, particularly in tech-related industries, will help the U.S. maintain an edge over other economies. This deregulation is seen as a vital step, allowing the U.S. to be less restricted by red tape, which in turn would support the economy in achieving sustained growth. Wood also addresses how advanced tech adoption and AI developments could further strengthen U.S. dollar returns on invested capital. She anticipates that with these new technologies permeating various industries, the U.S. economy will become increasingly efficient and profitable. Additionally, innovations in sectors like AI training and inference have the potential to drastically cut costs, which would drive economic efficiency on a broad scale.
What's going to drive the dollar? Returns on invested capital here, U.S., relative to the rest of the world. The policies, tax cuts, deregulation, keeping inflation down, and we can get into that in a moment. All of these are dollar friendly because returns on invested capital here in the United States, all other things equal, will go up relative to returns in the rest of the world. This is what happened during the Reagan administration. In fact, it was so extreme in the Reagan administration that it caused major problems in the rest of the world. Especially, they had inflation. We enjoyed lower inflation with the dollar going up, especially commodities are priced in dollars. So commodity prices to us went down. Commodity prices to other countries went up. And it was a very difficult time. So much so that in 1985, I believe it was, there was the Plaza and there were two accords, the Plaza and the Louvre Accords, both of which encouraged Treasury leaders from around the world to come together and agree to get the dollar down, including ours. What did that mean? It meant that we had to ease more. We had to ease, all other things equal. That's also very positive. So I think the thing that's going to keep inflation down even more, and this will be true in every country to the extent they adopt these new technologies, especially AI, is the massive productivity gain we're going to see. It's going to drive higher growth and lower inflation. And I think the U.S. being freed up, especially from regulation, which has been strangling us, is going to be a huge beneficiary relative to what otherwise would have been the case. That's also dollar positive.
Cathie Wood envisions a new economic model where innovation and productivity lead to a prosperous, low-inflation environment. By fostering a supportive regulatory environment, cutting taxes, and embracing AI, Wood argues that the U.S. could enter a period of strong growth without the inflationary pressures of the past. In this scenario, equities could experience another significant boom as the market embraces companies pioneering these emerging technologies. In her view, this setup would not only strengthen the U.S. dollar, but also cement the country's role as a global leader in technological advancements and economic resilience.
Please like and subscribe my channel.